Okay, welcome to the Payback Team Training Call. Today, what we're going to talk about is focus, and then I'm going to write an F and G illustration and just kind of walk you through that and show you how that's done. So, a lot of the high performers, the high performer people out there, they know what it takes and how important it is not to get distracted. And I wanted to bring that to this call because sometimes we do a lot of things in this world. We're taking care of our family. We're doing the things that we want to do. We're going out golfing. We're riding mountain bikes. We're doing all this stuff, but we don't realize how much time it takes when we're doing the things that kind of just draw us in and make us distracted on the things that we're not supposed to be doing, right? Or they pull us away from the things that we're supposed to be doing, even though we don't realize what it goes into, right? And the top performers in this world and any business, they know how much an hour of time can pull away. So I want you guys to think about this, right? The average American spends on average about an hour a day just scrolling. And that could be scrolling through social media, scrolling through websites, searching different places for different items, that kind of thing. It could be 15 minutes in the morning, 15 minutes in the afternoon, maybe a half an hour when you're sitting on the toilet, if you know what I mean. That's an hour. And before you know it, it's gone, right? Well, let's do some numbers here. Let's do some quick math, right? An hour a day, if you multiply that times 7 days, that's 7 hours in a week. Now, I don't know about you guys, but in most people's world, we live in a different kind of environment here in the life insurance business, but in most people's world, 7 hours a day, that's a full work day, right? They get an hour lunch, that's a full work day. 1 week, 1 hour a day. Now, you take that a little bit further and you go, that's one work day. You multiply that times 4 weeks in a month, right? That's 4 work days in 1 month that you're distracted or scrolling on social media, right? Now, if that's 4 work days a month, times that by 3 months and a quarter, that's 12 work days in 3 months, in 90 days. And if that's one work day a month, right? If that's, I'm sorry, 4 work days a month, not 1 work day, but 4 work days a month, that's one day per week, right? 1 work day per week. And if we just take that out per year, there's 52 weeks in a year. That's 52 work days per year that we get distracted, right? And 52 work days per year, that's almost 2 months off of 1 hour a day. That's almost 2 months off of 1 hour a day. Okay. And that could be for anything. And the difference between top performers, highly successful people are they understand what 1 hour a day can do. Right. And so if we think about that, now here's the kicker. Let me throw the kicker in here. The average person spends 4 hours a day being distracted. Now, that may be social media, that may be Netflix, that may be doing things that don't pertain to what they want. Now, I'm not a entertainment Nazi here. I don't want to sound like I don't want to, scroll and stuff like that. But I don't want you, I want you to think about that only because, not because I'm preaching it, because this is your life, right? This is our lives. Where do we want to be in 5 years, right? And 1 hour a day could mean the difference of, getting there and not getting there. 52 days a year, you multiply that times 10 years, that's 520 days. That's almost 2 years. almost, that's about a year and a half worth of time being distracted over a 10-year period. And that's the difference of now we can flip that upside down and use that and say, okay, if I'm distracted for an hour a day, that's a one work day a week. But let's flip that upside down and say, look, if I go and I learn during that 1 hour day, instead of scrolling on social media, maybe I'm listening to a book, or maybe I'm listening to a podcast from somebody that's doing something better than me. If I'm looking at my life over the course, over health, over finances, over, my physical health, if I'm, instead of scrolling up and down on social media or watching Netflix or something like that, maybe I go to do a physical workout. Maybe I go and, read a book for that hour a day. Think about that over the course of 10 years. That extra year and a half is going to get you closer to your goals than it will over the course of than it will if you don't do anything, right? So if you're doing that, using that extra hour a day, getting that extra 52 days back per year, you're actually you're ahead of most Americans, because that extra hour a day is what the average American is getting distracted with. Now, what I want you to really think about, and sometimes this hits hard because I did this and I thought about this and I'm like, okay, wow. But where you are today, look at what happened over the course of the last month, right? How many hours did you get distracted over the course of the last month? And that'll tell you where you're at today. And then you ask yourself, do I want to be there? Do I want to continue to grow, or do I want to, still use that hour? And so now let me dive a little bit deeper here. Why do people get distracted? What's the purpose of it? Well, with distraction, there's an immediate payoff, right? I mean, that's one way to do it. It's an attention seeking thing, right? We're talking about something that's grabbing your attention, right? But it's only short term. So it's an immediate payoff. Maybe if I look at this, it's super funny, it'll make me laugh, right? But why do I need to laugh? And here's the main reason. It's because distraction equals discouragement. You're discouraged about something that is going on in your life. Maybe it's your finances. Maybe it's, something bad happened with my kid. Maybe I'm not where I'm quite at, but I'm looking at social media and everybody else is farther than me, and so discouragement can drive what do I want to say? Degrade your opportunity to get there, because we're comparing ourselves, right? Instead of comparing ourselves to ourselves, we compare ourselves to other people as well. And so all of those, now you say, well, distraction, social media distracts me. No, you drove yourself to social media, right? That would be like dropping your kid off at the school and you don't say, well, the school is pulling my kid in. You don't say that, right? You drove your kid to school. So the school's not pulling your kid in, you're driving yourself there. Same way with social media. Same way with Netflix. Same way with, anything else that we get distracted with. Go to the fridge, right? Something bad happens in our life and we go to the fridge, or we go to the alcohol cabinet, right? And we get distracted. We use that to get the immediate fulfillment. And what that does is, over a long period of time, it hinders our success. And so again, I don't say this to preach to you. I don't say this to, be a fun Nazi, right? Where all fun things are bad. No, I say this to help you take a look at your life, because this is your life. right? And if you want to take a look at really where your life is at, look at the last 4 weeks. Ask yourself, where do I want to be there? Now, you've heard me say this over and over again. One of the tools that I use to help me stay not distracted is the calendar. I love to say that the calendar is the holy grail of where you want to take yourself in the future. And you can plan that calendar out as far as you want to, right? If you know what vacations you're going to take in the next 2026, put them on the calendar. Will they change? Maybe. But how easy is it to change something on your calendar? Where are your goals at by the end of 2025? We're almost to the end. We're halfway through we're about 95% through the first quarter of the year. Have you met your quarterly goals that's going to get you to the end of the year goals? Right? I always say, look at your goals by 12/31/2025 and then back them up and create 4 chunks, 4 quarters, right? Out of those goals that you have, there may be 10 of them. Pick 3 of them that you're going to work on in the next quarter. And if you don't get there on those 3 goals, if you can't check them off the list, then put them on that next quarter list, so that those goals will get you to your end goal, your yearly goal, right? And then chunk that down, each quarterly goal, into a monthly goal. What am I going to do at the end of this month, physically, mentally, spiritually, and financially? The 4 quadrants to get me to my quarterly goal. Because if I get to my quarterly goal, that's 1 step closer to my yearly goal, right? And then now you have your monthly goal. Now, what am I going to do this week to get me to my monthly goal? Now, here's where the calendar comes in. This is where it becomes really, really, really important. Every Sunday night or Monday morning, take time, make time, put it on your calendar to do this. The only way you're for sure going to get things done is if somebody tells you you need to do this at this time. Well, guess what? That's what the calendar is for. Use an electronic calendar. Do it on your phone. It is so easy to use an electronic calendar these days because it'll pop up with reminders, right? I even have sleep on my calendar. I have 10 o'clock, a reminder, okay, it's time to go to bed. Why? Because I want to get minimum in my life 7 hours of sleep. Why? Because I know I perform a lot better when I get 7 hours of sleep. Could I use 8 hours? Yes, but I want to use that extra 8 hours or that extra 8th hour to build my business, be with my family, spend time with my kids, use it to serve somebody through my church, right? I want to use that time, but put it on your calendar. Everything, put all your big rocks, your big things that you need to do, that you know you need to do in your calendar every single day, and make it repeating every single day, those big things, so that you get reminded that I need to do this. I need to do this. Then all that white space, put in there your medium rocks, right? Not the big ones. The big ones are the ones you have to get done. The medium ones are your work schedule. Maybe you have a doctor's appointment coming up. But what you need to do is look out every 2 weeks. But how often are you going to do this? You're going to do it every week. Every week you look out the next 2 weeks. Why? Because you're going to plan the next 2 weeks. But why do you do it every week? Because things change. Maybe next week you don't feel so good. You came down with a cold, so you got to schedule a doctor's appointment. Well, you got to take something off your calendar, or maybe you have a little bit of white space. You got to put something in that white space. You schedule a doctor's appointment. You got to move things around. Maybe you have a son that now, like right now, my son, his school is in the state basketball tournament. So we're going to that, and that's in Lincoln, Nebraska, which is 45 minutes away. So I have to put that on my calendar for this week. Last week, it wasn't there. We didn't know if he was going to make it. But this week it is, right? So this week we're blocking out that time, and we got to do that every single week religiously. Why? Because this is our life. This is where we're going. And part of our life is our family. Part of our life is our health, our physical stuff, right? Part of our life is our mental stuff. Part of our life is our spiritual stuff. And part of our life is our financial stuff. Because if you don't have finances, you can't support yourself, your family, or your community, or your friends, right? So make sure to work on all of that and take a look at the last 4 weeks and see where you're at. Get a judgment of where you're at. Write it down. I always find that if I take a half an hour and I'm trying to focus on something, I need to know where I'm at, and I need a clear picture of where I'm at. I'll take a half an hour, maybe an hour, to get a clear picture. Because if you have a clear picture of where you're at, then where you're going becomes clear. Think about this. If I picked you up and there's no GPS, I picked you up and I dropped you in the city, Little Rock, Arkansas. I don't know how many of you have ever been there, but let's say none of you have ever been there. Drop you in Little Rock, Arkansas, and I say, okay, go to the next Walmart. And there's nobody around. It's 2 o'clock in the morning, everybody's sleeping, and you don't have a GPS device. How are you going to get there? You're going to go wander around trying to figure out how to get there. And it may take you 3 hours to find the nearest Walmart. But here's the kicker. The Walmart's probably just 2 blocks away. You just didn't know it because you have no clear path on how to get there. That's the way life is if you have no clear path on how to get there. If you don't know where you're at, how are you going to create a destination of where to go? The only way GPS devices work is if they have 2 things. They know where you're at and they know where you're going. You need to be the GPS device for your life. You have to know where you're going. Okay? Now, if you get distracted, because distractions come, I hear people say, well, my kids are always distracting me. Well, yeah, they're part of your family. They're going to do that. They're little ones, right? Not all distractions are a big thing or a bad thing, right? My business distracts me. Well, your business can't distract you because that's what you need to do, right? Or I'm taking, I don't know, I can't think of another distraction, but that's a famous one. My kids, or I'm sick, or this happened or that happened. Not all distractions are bad, but you have to put those into your life and understand that those things are going to come, and don't get discouraged. This business is, all sales businesses are up and they're down, right? You get super happy on the days when you sell a policy help families, and you get really, really happy when you sell multiple policies and things are going up and things are rocking, right? If you think about those times when that happened, the good times in your life, you didn't have any discouragement, right? So you're focused, you're locked in, and things are going well. And then all of a sudden something happened. Maybe you had a chargeback, or maybe you got a bad batch of leads, which can happen, right? Or maybe you went on vacation and came back. Now the momentum's gone, right? So now you have a little bit of discouragement in there. So rather than taking the hard path and getting back on track, you spend an extra hour getting distracted, maybe watching a movie or looking through social media or searching for that thing that you really don't need on Amazon, but you just want. Why? Because it's a distraction. Or maybe you have a couple extra drinks to relax a little bit. Or maybe you go to the fridge and now you have a couple of extra cheat meals that you know you're not supposed to have, right? So the whole point though is just to take a look at where you're at, because we're coming up on the end of the third quarter. take a look at where you're at and plan. We're still at the beginning of the year. We still have a lot of time. We got 9 months ahead of us. Where do you want to be in 2025? And then create that life for yourself. If you haven't sold your first policy yet, make that a goal. And when I say make it a goal, that also includes make it happen, right? Then sell 2 policies a week. Then sell 10 policies, right? Keep improving. Don't get discouraged. Don't go up. Don't go down. Just keep it an even keel. Always know that, today's great days won't always be great days. But on the flip side of that, today's bad days won't always be bad days, right? Have a little bit of faith in yourself because you are here for a reason. You're here and you are a life insurance agent for a reason. These people that are clients of yours, these leads, these guys, you're the only licensed agent on the phone. And so they don't know. You ask 90% of them, you ask 100% of them, what's the difference between term and whole life? 90% of them won't give you a definite answer. Some of them will say, yeah, I know. And then they explain it to you and they have no clue what they're talking about. Right? So you guys are the ones that know the most about life insurance and you're the only licensed agent on there. So have the confidence and the faith in yourself that you could sell the policies and you could sell a lot of them and work towards learning more and more and more to get to where you need to go. Okay. All right. So I've already ranted a lot. Now I'm going to transition here into, I'm going to share my screen again. I'm going to transition into doing a illustration for F&G. All right. So we're going to come over here. Oh, no. Oh, it logged me out. Okay. Technical difficulties. So on F&G, you get on the site, and then right here under products, sales tools, you'll hit illustrations. Oh, it's going to ask me to log back in. Hit illustrations. Explore illustrations. And then now you would hit start case. You'd plug it in there, plug all the client's information in there. But I already have one saved. So I'm going to just kind of open it up. And we're going to open up Oscar the Grouch here. Okay. And when you click on new illustration or new client, this is the screen that you're going to see. Okay. So you put the client's information in here. You click on Path Setter. And the majority of the time, that's the one you're going to want to use. Now, they made this super easy. They got this button here called Run Quick Solve. Okay. So you want to run, here's all the information you just put in. Okay. If the owner is different, you're just going to click this button and then you'll put the owner's name. Like, let's say they have a child that is underage, then the parent needs to be the owner of the policy. Okay. And then you're going to run everybody at standard non-tobacco, unless, of course, they're a tobacco user, then you would run them at standard tobacco. Okay. Now, when you go through the underwriting after you submit the request with F&G, if they do get a preferred rating, they will give them that preferred rating without no questions asked. They will let you know that they qualified for a preferred rating. Then you just come back and rerun the illustration on the preferred rating and explain that to the client that, wow, you got a better rating. Good job. Now, if you are not sure of if they qualify, you can hit this button and then open it in another tab. Let me see if it does it. Yeah, it automatically does it. And then what you could do is type in here. I use Command F because I have a Mac. I'm not sure what it is on a PC. Maybe it's Control F. And then you type in something like diabetes. And it'll take you to the matches of diabetes, right? So preferred underwriting criteria, no personal history of cancer, except or certain cancers, diabetes, or heart disease, right? So and then down here, some more guidelines. You guys can take a look at that. That's not, you guys can discover that on your own. So here, what you want to do, here's the solves. When you first open this, it'll show it to you like this. But they put this run quick solve in here, which is amazing. And it's especially great for newer agents that haven't ran any F&G. You can hit that button. And then you can, this right here would be a max accumulation valued policy. Okay. Now let me back up here. What is a maximum funded IUL? Now you say that to a client and they're going to think, well, I need to put all my money into the policy. I need to max fund this policy, right? And that's not true. What a max funded policy is no matter what their payment is, let's say it's $1,000 a month. No matter what their payment is, what we're telling the software is we want to have the lowest cost of insurance so that we can maximum fund that cash value into the IUL so that it can grow tax-free. That's what a maximum funded IUL is, okay? So make sure that when you talk about that to your clients that it's distinctly clear on what that means to them. So you can do face accumulation, you can do premium for accumulation, and this is all with income. You can click this button and say no income. And then this is for death benefit. So this is for somebody that wants to maximize for a death benefit, meaning that they want the majority of their payment to give them a higher death benefit, which gives them higher living benefits as well. So for this one, I'm just going to do face amount, accumulation, no income. So it's not going to show any income coming from the policy. Now notice what it does. It takes the face amount and it does a varies option B to A. Now depending on the carrier, what this means is option A is level. So that means their death benefit is going to stay level all the way to age 65. Option B is increasing. So other carriers may say increasing, other carriers may say level. That's the difference. A is level, B is increasing. So this says varies option B to A. What does that mean? Well, what this means is it's going to increase their death benefit all the way to age 65, and then it's going to drop their death benefit after age 65 to the lowest amount possible. Why? Well, if we're dropping the death benefit at age 65, well, let me back up here. If we want to max fund a policy, we want the lowest cost of insurance. Now, with a level premium policy, level death benefit policy, that death benefit is going to be higher than it would be for option B or increasing, and it's going to stay the same. And it's going to stay the same all the way throughout their policy until the cash value grows high enough to where that death benefit has to go too. Now, so in a level death benefit, the cost of insurance is going to be higher as well. The cost of insurance is going to be based off of that face amount or that death benefit and the living benefits that come along with it. And so if we're trying to max fund the policy, we want to do increasing because what it does is it drops the death benefit so that it's low enough so that it's the minimum amount that the client can have per IRS guidelines to keep it a life insurance policy and maximize the cash value. But since it's increasing every year, they get older. So the cost of insurance goes up because the older they get. Because insurance carriers, they base all of this off of the age and the health of the person. Now, the average male dies at average 78. The average female dies on average 83. And so the insurance carriers know this, and they base their policies off of that knowledge that they have. They also base it off of what prescriptions they're on, what health conditions they have, right? So basically right here, we want to do increasing to level, because at age 65, we want it to level out or even drop the death benefit. Why? Well, they're paying into the policy, and this policy is being designed to use for a tax-free, to supplement a tax-free retirement. So if it's designed for a tax-free retirement, when you retire, you don't want to pay into the policy anymore. You want to take out. And so if we're not paying into the policy anymore and funding it, we don't want the death benefit to go up anymore. It eventually has to if the cash value grows too high, but we don't want it to as much as we possibly can. We want to stay away from that. So this is designed to level out at age 65 and never go up anymore. Okay. Now, if we scroll down here, it tells you about the premium. You can see the guidelines. It's monthly, okay, specified level, and it's a 15-year forced minimum premium. Okay. Now that means that it's not going to lapse in 15 years no matter what. Now this policy won't lapse anyways. Now down here are the allocations. They're interest crediting options. Okay. Now F&G has it defaulted to Morgan Stanley, 50%, and BlackRock, 50%. Okay. Now you guys can do whatever you want with your allocations, but here's what's important. Learn about your allocations. All it takes is a little bit of research, and you can find out what's going good right now. How do you do that? Well, you can come right back here. Okay, where do I find this link? Right here under interest rates. It's on the home page of F&G's website, and all of the major carriers have their websites here. Okay, now if you're new, don't worry about learning interest rates. If you haven't written an IUL before, don't worry about learning interest rates. Why? Because they have a default here. Whoops. Let me close that out. Here's the default, right? Just use the defaults. Then don't worry about it. A year from now, when you do a policy review, you can always go back and reallocate funds when markets aren't doing better. Or if they're doing the same, you just leave it the same. So don't worry about the interest rates. Just go with the default if you have it. But it's good to get some knowledge. So where do you get the knowledge? Well, this is their interest rates that F&G has done and their indexes. So you just click on this button and it's going to open up this page, right? Here's your product interest rates. Now this is F&G Everlast, but our IUL is F&G Path Setter. So here's all the indexes right here. So you can see like the Barclays Trailblazer Sector 5 Index has a 1.1% with a 1% bonus. Now here's what you need to look at. Here's the cap rates. Here's the participation rates. The participation rates are basically a supercharger, right? They're a multiplier. And so what they do is, let's say, okay, so this has no cap. If there's no cap here, that means there's no cap. Now these right here are volatility indexes, meaning they usually perform pretty low. That's why they're called volatility indexes. They hold the volatility of everything. S&P is a non-volatility index, so it can go up and it can go down. Here's the S&P. The cap right here is 12%. Okay, so what that means is the carrier is going to get anything over 12%. This is the way I explain it to my clients. And they also get anything under 0. Now I want to go back up here to the Barclays Trailblazer. Notice it has a 1% bonus. What does that mean? Well, this means that this particular index, the floor is 1%, not 0. So they will always be guaranteed to get that 1%. Okay. Now this is a fully underwritten plan. So you would look at 170%. Now this one over here, this carrier has 2 of them. This is called a low band and it has a 1 there. So if you look right here down to low band, it says between ages 18 to 45 and they're under 150,000, this would be the allocations. They'd get 155% with no cap, right? So here's an easy way to think of participation rates. Let's say that this index did 10%, right? And so instead of getting 10%, you would multiply that times this multiplier here, the participation rate, or the supercharger, I like to call it. 10% times 170%. Actually, if this did 10%, you would actually get 17% credited to your account. So 10% times 170%, right? That's what would be credited to your account. Now, how do you do research on these indexes? Well, you can literally just Google it, right? You just copy that and type in here, and boom, here's your BlackRock. You just type it in here. Here's the Trailblazer, right? And you click on performance, and what you want to look at is year to year. So here's the Barclays Trailblazer Sector 5 Index, right here. And you would look at, this is the year. See, this is a volatility index. It goes up and it goes down, right? But it doesn't usually perform that high. Sometimes it does. So if it did 10.38 and you have 170% participation rate, there's your 17+% right there, right? 10% times 170. Okay, but right here, look, in this year right now, it's performing at 2.27. So if you do, where's my calculator here? If you do 2.27 times 170, whoops, I got to back up. Didn't get the 1 in there. 170. That would have done 3.85%, right? Which is still better than 0, right? So you can see this one isn't performing that great right now. Last year it did negative. So if I want to put my clients in here, I want to know, obviously if it did negative, they would get 0. But this has a 1%, so they'd still get 1%. Okay. Now, if I were to take a look at, now let's go back here. The other one that they like is the Morgan Stanley and the BlackRock. So let's look at the BlackRock. It's got 100 annual point to point. Point to point means the anniversary date. Okay, so what that means is that month that you pay in, they're going to look at the next year on that same month that you pay in, and that's the anniversary date. And they take the average throughout that year, and that's what's credited to your account. So the next month when you pay in, that's another point to point, right? And so every month it's crediting, and then at the end of the year, they credit everything. Okay, I know that's kind of confusing. If you have any questions on that, you can reach out to me. But here, look at the BlackRock. It has point to point. There's no cap and 160% participation rate. Okay, if we look right here, BlackRock, no cap, 160% participation rate, also with a 1% bonus. So that's a 1% floor that it has. It doesn't go to 0, it goes to 1%. Now this one's illustrating at 6.44. What does that mean? That just means that that's what they're going to show you on the illustration. That's all that means. Doesn't mean that that's what that's doing. That's just mean that's what the carrier is going to show you on the illustration. Okay. But this does 160%. So if we look at BlackRock, look, so far in 1 year's time, it's 1.58, right? So it's not doing very well as well. That's why these are volatility indexes. Okay, and if we go over here, let's say we do S&P. Here's the S&P ticker. Still going down, but if we look at it year over year, it's up about 7% over the last year. Okay, now it is going down. Look, see, it's going down right now. So the markets all around aren't doing very good. But why are these attractive, IULs attractive to clients? Well, because of the 3 main things, right? Number 1, they participate in the gains. They never participate in losses. Number two, they're tax-free when you take them out in the form of loans. Okay, and so they're all tax-free. So no matter what they make, if they're in a 25% tax bracket, they're making 25% already, because if it was in a 401k or any other type of investment, they're paying 25% on a tax bracket. Just hypothetically here and averaging here, right? So even if they just make 5% or 7%, they're still doing a lot better. Think about 7% plus the 25% of what they're making in any other type of investment. Okay. Now, so you guys kind of get the hint off of that and can see how that works. You want to look at these, learn about these, study these, right? Especially when you get your own IUL. That way, when you do 1 year policy reviews with your clients, then you can look at this and say, okay, this is doing pretty good right now. We think this is going to do better. The market says it's going to do better. We're going to allocate funds to this. And you can change the percentage rate, right? So yeah, just learn about these. And it's fun just to do a little bit of research in here. And the way you do it, again, is right here under interest rates on F&G. Okay, so let's get back in here. We'll scroll down here just a little bit more. If you know they want to take out loans, you could plug that in here. Here's the additional benefits. You can see here's their living benefits that are already in here. Okay. And then what we're going to do, see, it's already checked right down here. Okay. And then if you want to include the monthly charges and expense report, you can hit that button and it includes that in the illustration. Now, if you want a quick check, you can click on calculate results and it'll do that for you. You can also click on this and do max accumulation and income, or just max accumulation. This is the old way of doing it. Okay. So this is where you would put in your premium, right? We're going to pay premiums to age 65, minimum non-MEC death benefit. Then you click this button, and this is what we're looking for when we pay premiums, right? We click here, zero that out, and let's say they want to put in $1,000 a month. Okay. Now, what if they want to stop paying at age 65? Well, this is showing them all the way down, right? So what we want to do is say age 66, we're going to zero this out. You have to actually type 0 in there. Whoops. 0. Now it's going to zero it out for the rest of their life. Okay. Now hit that button. Click OK. Now we can calculate results. It's loading. Now you can see they're putting in $12,000 a year, right? Here's their death benefit. We did increasing to level, right? So you can see by the time they're 65, they're going to have almost $250,000 in there. And then that's where the death benefit levels out. And their cash value keeps growing, but their cost of insurance doesn't grow anymore. Okay, now, if you compare this to like a 401k, let's say they're building it and building it and building it, and at 65, they retire and they have $229,000 in there. Well, if they die, they don't get the $229,000. The beneficiary don't get the $229,000 if this was a 401k. They're going to get the $229,000 minus the taxes. But here, since this is a life insurance policy, when they die, they don't get $229,000. They get the death benefit of almost $400,000. So it can leave a legacy to their family tax-free. Hence the benefits of the IUL. Now, for the rest of their life, they don't have to keep putting money into this. They're going to keep growing the cash value on this. Okay. Now, here's the other thing. When they borrow this, if they use an alternate loan or a participation loan, which is what it's signed up to do, then let's say right here they're 72 and they say, I want to take out 200,000. Let's say they want to take out 300,000, they're left with 77,000. Maybe they want to put a down payment on a house or something. And they have another stream of income, so they're not worried about the income from this policy. So they take out 300,000. 300,000 is going to come off the death benefit, of course. So their beneficiary is going to get the remaining balance of the death benefit minus the 300,000, right? But here's the thing. Even though there's 300,000 missing, there's still compounding interest on the 377 accumulated value over time. This is the account value. Okay, and that is one of the third reasons why the wealthy have been using this for years. Okay, now you can see there's still 300,000 missing out of here, and they didn't even pay it back. But look, it's still compounding on this, and so take 300,000 off of this, and they still have 2.1 million in there by the time they're 98. And that's how you run an illustration with F&G. So yeah, you want to make sure the details button pops up right here. And this is where you put in the amount that you're going to pay. You can also change this to show income, max accumulation with income. Okay. And then you can put in here how much income they want to start, or you don't have to put anything in here. The income starts at age 65 and it'll go for 25 years. Okay. Now you can change this, put in 30 or 40 or whatever for the rest of their life. Okay. Now we hit that. Now their income, it's going to show income at age 65 after they stop paying on it rather than just growing. Look, so they put in 12,000 a year, right? For the rest of their life, they're going to be able to take out 22,757 tax free. Okay. Now if you do the math, 12,000 times 14 years, they have 168,000 in there, right? Now 22,000, let's say 168,000, divide that by the 22,000, what was it? 22,757. In 7.3 years, they will have money taken out, the same amount taken out that they have put into it over the course of their lifetime. But look, in 7 years, they're going to be 73. And for the rest of their life, they get 22,000. Well, until they're 90 on this illustration. But it's the same thing, right? And they can keep growing it or take out more money. Right? So it shows, this way it shows the income that they can receive. So it really all depends on what your client is looking for. You need to, dig deep and find that out, what they're looking for. But this is how you run an illustration with F&G.